Now, I get asked a lot of questions on the tax treatment of assets if they get passed through a will or if they get inherited by someone. Now, a very important date to remember when it comes to these assets is 20th of September 1985. This is when capital gains tax came in. So any asset that was purchased by someone that's passed away before the 20th of September 1985 is pre-CGT, and therefore, once it comes to you, you don't need to pay tax on that amount. Basically, what happens is at the time of death, when the asset gets distributed to you, let's say it's a property worth $1 million, you don't have to pay any tax on the gain before that. However, the cost base gets reset in your name once you get it. So after the next 10 years, if it goes from 1 mil to 2 mil, then you have to pay capital gains tax on the $1 million you've made there, depending on your tax rate, before you can, when you sell it at the point of sale. What about assets that were purchased by people after the 20th of September 1985? Well, these are a different category. Now, basically, at the time of distribution, there is a tax effect. Somebody has to be liable for that capital gains tax that flows on to the next person. So, is it you? Pretty much it will be. Basically, when the asset comes to you, the cost base is at the start of when they first purchased it. Let's say it's the 1st of January 1990. Yes, you've held it for longer than 12 months, so you will get a capital gains tax discount. However, at the point of sale, when you decide to sell it, you will have to pay tax on the entire amount the property has made. Not great, but when you sell it, you've really got to think about, well, is it actually worth it? What are the tax effects? This can really put you out a little bit. Let's think of the family home. A lot of Australians have all their wealth tied up in the family home. Now, this is a little bit different from it as a tax treatment. Basically, the government looks at it and says, okay, they lived in the home, it should be a tax-free asset. Yes, it is. If it comes to you, you have up to 2 years to sell that property to not have to pay any tax on it. Doesn't matter when it was purchased before. What if you want to live in it? Well, if you want to live in it, then your parents need to make sure that in their will it's clearly articulated who's going to live in it to ensure that this asset or this family home can stay in your name and be a tax-free asset. It might be something really important to talk to them about if they're sort of coming toward the end and you want that house or you need that house. Talk to them about if they've got you ready into the will to take the house. Having these conversations about inheritance with your loved ones is so important so that everyone knows where the assets are going to go and to ensure there's not a fight at the end of it. So there's a little bit of information on how the tax treatment of inherited assets is working in Australia right now. Things are always changing. So make sure you get advice whenever something like this happens. I'm Stefan Angelini. Thanks a lot for listening. If you have any comments, feel free to leave them below. Thanks.